All right, welcome back to another Billionaire Brotherhood explainer. Today, we're basically acting as your insider researchers, and we're leaking the exact playbook the ultra-wealthy use to legally dodge income taxes. We're going to break down the mechanics of a wealth generation system that honestly might just fundamentally change how you view money, debt, and taxes forever. So let's just dive right into it. We really need to start by shattering this whole illusion of the billionaire paycheck. You know, when you or I think of getting rich, we usually picture earning a massive, heavily taxed salary. But here's the thing, the ultra-rich don't earn income like regular people. Because if you take a massive paycheck, well, you pay massive taxes. Instead, they use a tool that most of us associate with sheer financial stress, and that is debt. This whole mindset shift is perfectly captured by a quote from Rick Calero. He's the head of banking and lending over at BNY Wealth. Extreme wealth isn't built on cashing big checks. It's built on leveraging an entire portfolio of assets. They literally treat their personal finances like a corporation. They utilize their full balance sheet to fund their luxury lifestyles without ever triggering a taxable event. To understand exactly how they pull this off, we're going to break down a three-step framework known as buy, borrow, die. This wonderfully blunt concept was actually first coined by USC law professor Ed McCaffrey way back in the 1990s to explain exactly how the rich stay rich. So let's walk through how each of these three steps works in the real world. All right, starting with step one, buy assets, not income. This is the absolute foundation of the strategy. Instead of working for a heavily taxed salary, the ultra-wealthy use their capital to buy appreciating assets. We're talking stocks, commercial real estate, fine art, you name it. And here is the fundamental rule of the U.S. tax code that makes this all possible. Unsold assets and debt are not taxed by the government, period. As long as you just hold the asset and watch the line go up, it is legally invisible to the IRS. You do not trigger a capital gains tax event. You only pay taxes when you actually sell. So the billionaire's prime directive is super simple. Never, ever sell. But if you never sell, how do you buy groceries or, a 300-foot super yacht? Well, that brings us to step two, borrow billions. This is definitely the most controversial and crucial part of the entire playbook. Using those unsold assets as collateral for massive, completely untaxed bank loans. See, because loan proceeds are classified as debt, not income, the IRS does not tax a single cent of it. You get all the cash you need to fund a lavish lifestyle completely tax-free. Now, you might be wondering, wait, don't they have to make huge monthly loan payments? Actually, no, not necessarily. Banks structure these loans uniquely for the ultra-wealthy using instruments like zero-coupon bonds. What that means is there are zero monthly interest payments draining their cash flow. Instead, the total amount plus all the accumulated interest is just due years down the line at maturity. And when that date finally rolls around, they simply refinance the debt. They roll it over endlessly while their underlying assets just continue to grow. Okay, let's look at the hard math to prove why this works so ridiculously well. This is based on a study from BNY Wealth. Imagine two investors, right? Each has a $30 million portfolio earning about 13.8% annually. Now, they both need $3 million in cash. Investor one does what most of us would do. They sell $3 million in stock, they pay the massive capital gains tax, and they lose out on all future growth of that money. But investor two, they use the buy, borrow, die method. They borrow the $3 million against their portfolio, leaving their original $30 million completely intact to keep compounding. The results are wild. After just 5 years, investor two, the guy who borrowed the money, is nearly $19.7 million richer than the investor who sold their stock. $19.7 million. And that is their net advantage even after paying almost $3 million in loan interest. The cost of borrowing from the bank is vastly cheaper than the cost of interrupting your compound interest with a massive tax bill. It's basically mathematical magic. But eventually, the bill has to come due, right? Well, that brings us to step three, die tax-free. So you've bought, you've borrowed, and you've compounded your wealth into the absolute stratosphere while living entirely on borrowed cash. When the wealthy individual finally passes away, the ultimate tax eraser activates. It's called the stepped-up cost basis loophole. When heirs inherit a heavily appreciated portfolio, the tax code actually resets the original purchase price of those assets to their current market value on the exact day the person died. This legally erases all historical capital gains. Poof, just gone. The heirs pay off the bank loan, and they get to keep the massive fortune without ever paying a single dime of income tax on a literal lifetime of growth. Next up, the billionaire receipts. Because I know this sounds like pure theory,
but it is standard operating procedure for the ultra-rich. Let's look at the evidence to see exactly how the world's richest titans actively deploy this exact strategy today.
You definitely know these names. Larry Ellison, the founder of Oracle, reportedly secured a $10 billion personal credit line backed by a stock. $10 billion. He used it to buy things like a $300 million Hawaiian island without triggering a massive tax event. Then you've got SEC filings showing Elon Musk has frequently used huge portions of his Tesla shares as collateral for personal debts. And remember those famous ProPublica leaks a few years ago? They revealed that titans like Jeff Bezos and Warren Buffett pay astonishingly low effective tax rates compared to their massive wealth growth. Why? Precisely because their wealth is tied up in unsold, appreciating assets, not taxable income. And the playbook doesn't even stop at loans. There's another related tactic: converting personal luxury items into corporate business deductions. For instance, billionaires like Elon Musk will place private jets into corporate ownership structures. As long as they meet IRS guidelines for business usage, the operational costs, the maintenance, and even the depreciation of these multi-million-dollar jets become entirely legal corporate business deductions. Moving on to the everyday investor playbook. Clearly, the ultra-rich are playing a completely different game than the rest of us. But how can we apply these concepts at a smaller scale? Can you actually use buy, borrow, die? Well, the honest answer is that you really need massive wealth to run the full consequence-free scheme. However, the underlying principles of the strategy, leveraging assets and aggressively deferring taxes, those are absolutely available to the upper middle class and the everyday investor. So here is your actionable playbook. First, you can mimic the tax deferral of billionaires by maxing out your tax-advantaged accounts, like 401ks and IRAs. Second, if you need liquidity to fund a major life expense, maybe consider a home equity line of credit, or a HELOC, instead of selling off your stock portfolio and sugaring capital gains taxes. Third, always try to hold investments longer than 12 months to ensure any sales qualify for those lower long-term capital gains rates. And finally, utilize tax loss harvesting to offset any gains you do end up having to take. But, and listen to me, this is a massive but, using leverage requires extreme care. When a billionaire takes a loan against $1 billion in stock, they have an incredible amount of padding. If everyday investors over-leverage a home with a HELOC or take margin loans on a much smaller stock portfolio, a sudden market downturn can literally wipe out your collateral. That leads to devastating margin calls or, worst-case scenario, the foreclosure of your primary residence. So keep in mind, the risks scale down much more harshly than the rewards do. Which leads us to a pretty harsh reality. It takes wealth to create wealth. While this entire strategy is perfectly legal, it inherently and exponentially favors those who already hold significant appreciating assets. The tax code is literally designed to reward investment in capital formation over wage earning. If you only have a W-2 salary, you have almost no access to this system. And really, it all comes back to this magic number, 0%. It's the number that makes the entire buy, borrow, die playbook so profoundly appealing to the wealthy, so controversial to the general public, and so undeniably powerful for multi-generational wealth generation. Avoiding that tax hit is the ultimate goal of asset leveraging. So, we're going to leave you with this final provocative thought to consider. Look at your own financial trajectory. Now that you understand the insider mechanics of how the absolute wealthiest among us bypass the income tax system entirely, ask yourself, will you continue trying to build your wealth purely through highly taxed income, or will you start finding ways to acquire the assets that unlock untaxed leverage? Definitely something to think about. Thanks for joining us on this explainer, and we'll see you next time.